Hey guys, what is going on? Welcome back to the portfolio. Welcome back to the channel. For today's video, I want to take a look at a couple different exchange traded funds or ETFs, investments that would be great additions to any investor's portfolio. I want to do this because there's been a few investors on the channel, new investors to the stock market that are a little bit unclear what would be a great initial investment to jump into. So I thought I'd take a look at ETFs, what an ETF is, and then a couple that I have been taking a look at. One that's currently in my portfolio and one that I've been looking at for quite some time. One that's been in the press recently because of its large holdings in innovative companies, including Tesla. So I want to take a look at those today. For viewers that are new on the channel, ETFs are essentially investment vehicles that trade like a stock. They are very easy to manage. You can simply buy and sell them like any individual company, any security, any stock on the stock market. But when you do buy an ETF, you actually are buying a collection of underlying companies that are composed within that fund. So for example, here, one of my favorites is VOO. This is a Vanugard fund. It's an S&P 500 fund. If you take a look at the bottom of the screen here, there's a very brief overview of exactly what this stock is. This is tracking a market cap weighted index of US large and mid cap companies selected by the S&P 500. So this essentially is one stock. You trade it like a stock, but it's composed of 500 individual companies. If we take a look at the Vanugard website, again, you can see an overview for VOO here up on top, product summary, invest in stocks in the S&P 500 index representing 500 of the largest US companies. Its goal is to closely track the index's return, which is considered a gauge of overall US stock returns. It offers a high potential for investment growth. Share value rises and falls more sharply than that of funds holding bonds, and are more appropriate for long-term goals where your money's growth is essential. So essentially, you're buying into a collection of blue chip companies here. If we take a look at the ETF facts here, this is very important when you take a look at what ETF to jump into. That expense ratio in the middle there, 0.03%, is one of the lowest you can find with an exchange traded fund. And this is what the fund is charging the investor with regards to fees, advertising, the management of the fund. Again, since this is an index fund, a passive index fund, and again, up on top, that is simply following the S&P 500 index, that is a quite low expense ratio. But other investment vehicles like a mutual fund, for example, can have an expense ratio of anywhere from 1% to 2.5%. However, other ETFs on the market, including the other one we'll talk about today, ARKK, they can have very large expense ratios. So definitely take that into consideration. And over day to day, you don't really notice this. This isn't a fee that's going to be charged to you at some point on your portfolio, but this is definitely something that'll be taken out of the intrinsic value of the stock of the ETF. So for example, if you invest $10,000 over 10 years, that $10,000 may grow to $26,000. But at 10 years, you'll be losing about $1,200 in fees if you have a 0.5% fee. Over 25 years, that will grow to $67,000, but your fees will be anywhere from $6,000 to $7,000. If it's a 1% fee for expense ratio, that $10,000, again, at 10 years would be about $26,000 of investment, but you'll be paying $2,000 to $2,200 in fees. At 20 years, again, that $10,000 is growing to $67,000, but you'll be paying anywhere from $1,200 to $1,300 in fees. And if you can imagine, that's just $10,000 worth of investment. If you have $100,000 or $1 million, you can times that accordingly. So not insignificant fees if you take a look at this over the longer term. So definitely take a look at that. And then let's go down to the other important thing to take into consideration, and that is what are the companies in the ETF. Here you can see the 10 largest holdings in VOO. You can see these are quality blue chip companies. Top 10 here: Apple, Microsoft, Amazon, Alphabet, the parent company for Google, Facebook, Tesla, Berkshire Hathaway, JP Morgan Chase & Company, Johnson & Johnson, and Visa. So again, instead of individually buying these stocks, you simply buy VOO and you get all of these stocks within the portfolio, as well as 490 other stocks. Again, these are all passive selections. Here in the middle, you can see portfolio composition, kind of looking at the market segments that's going into this particular ETF. And again, hypothetical growth of 10,000 over time. Again, the discussion with the fees, expense ratio fees, take that into consideration as well. Those would be subtracted, again, from the intrinsic growth of a particular investment vehicle like VOO. So again, I think this is a quality ETF. Let's go back to Robinhood, and you can see currently I have a position of 40 shares, 14,519 in the portfolio. My total return, 60.36%. Take a look at the longer term growth here. Very good over the past 1 year, 50.83%. And 5 years, you can see here, up at 95.79% with that very large pullback with the start of the coronavirus pandemic back in March of 2020. But since that time, it's responded very nicely here. So again, a new investor on the market, you don't have to pick individual companies. Jump into this, you get instant diversification. It's very easy to trade, and it's got very low fees. Again, expense ratio 0.03%. Another ETF that I've been taking a look at for quite some time, a more controversial ETF, is ARKK from the ARK Invest line of investments from Catherine Wood. So you can see that stock up here on screen, ARKK. Again, just like VOO, this is a fund that has a collection of stocks within it. Trades like a stock, very easy to manage, just like any other stock investment. Take a look at the longer term growth here, very good growth. 1 year up 190.79%. Over the past 5 years, you can see a phenomenal 588.57%. And I want to bring this one up because I've been looking at this for quite some time. You can see I do not have a position in this particular ETF, and it has very large holdings of innovative companies that wouldn't necessarily be considered blue chip companies, but have potential for growth moving forward. So let's take a look at the ARK Invest website. So up on screen here, you can see ARK Invest. It has a number of different ETFs within its portfolio. You can see here, this is currently the ARKK investment, an innovation fund. We take a look again at the expense ratio, 0.75%. So this is a lot higher than VOO. Again, VOO is 0.03%. This is 0.75%. So this is substantially higher than VOO. Definitely have to take that into consideration when looking at funds like this. And if we take a look at the overall holdings in the portfolio, you can see these are definitely different than those that are in VOO. So here, top 10 holdings, these are much more, I would say, volatile companies. Tesla, Square, Roku, Zillow. These are extremely different than what would be held in VOO. CRISPR on the bottom there as well. So these are definitely more innovative companies, companies that have more potential for growth. And there's a number of different ETFs within the ARK Invest ETF line. Genomic Revolution, like CRISPR, for example, here, DNA technologies, industrial innovation, robotics, automation, next generation internet, infrastructure services, fintech innovation, and financial services. So this is definitely a different type of company, or different types of companies that are in this particular investment fund. So take a look at both the expense ratio as well as the underlying composition of companies. So if a new investor jumps onto the market, they can buy a few shares of VOO, for example, get into some very nice blue chip companies, and then also invest in something like this, an ARKK ETF that has exposure to innovative companies, higher risk companies, more volatile companies, but something that could further diversify their underlying portfolio without necessarily having to pick any one of these individual very risky companies. As Tesla, we've been following in the portfolio, it's been going up and down quite dramatically. So for a new investor to put all of their money into something like Tesla, it could be very rewarding longer term, or you can lose most of your money. So this would be a safer way of doing it. Again, ARKK here as well as VOO, two great investments, two ETFs here to at least consider for new investors on the stock market. And again, I'm not a licensed professional. This is simply my opinion. Don't make any buying decisions off of this video or my opinions only. So again, just wanted to go through two very good ETFs here, at least ETFs that are good in my opinion. VOO, more traditional ETF with very low expense ratio, 0.03% low fees, and then a more innovative company here, a more controversial company, ARK Invest, ARK Invest, that has a number of underlying ETFs, including the one up on screen here, ARKK. So very interesting ETFs here. If you guys have better ETFs out there, let me know what you guys are invested in. I'm thinking about putting some money into ARK Invest here. So not to make the video too long, I'll kind of end it here. Again, if you guys enjoy the content on the channel, if you guys enjoy the video series, feel free to like, share, and subscribe. Until next video, we'll see you then.